Hello, my name is Benjamin Tan, and I'm the Securities and Education course, i.e. the SEC co-lead lecturer. SEC is student-led course run by the Investment Society, and welcome to the SEC Winter Special, which is the 20-minute condensed bite-sized version of the lecture for you to brush up on your knowledge in the winter holiday.
Hello, my name is Sebastian Stewart, and I'm the co-lead lecturer along with Ben. The SEC is a finance lecture series based on the CFA Level 1, covering a range of topics ranging from equities to real estate to FX and many more. This lecture series is ideal for beginners as well as advanced and intermediate students. We hope you enjoy listening to the podcast as much as we enjoyed delivering the lectures. Thank you for all those who attended the course this year. We had a record level of registration and hope to welcome more of you next year.
Hey guys, my name's Lassen and I'm a fourth year aeronautical engineering student at Imperial College London. I did a spring week at Morgan Stanley and spent the summer in the real estate private equity division at Ares Management. I'm back from the accounting lecture and I hope you guys have enjoyed the previous few episodes. So let's move on to real estate. What is real estate? Real estate is simply put a property consisting of land or buildings. Taking this further, it can be land or any permanent improvements to the land, whether that be natural or man-made. There's lots of different types of real estate, whether that be residential, the houses you and I live in, industrial, office, logistics, retail, student housing, and many more. Historically, the prices of real estate have been on an upwards trend. There have been different market blips, whether that be in 2008 due to the financial crisis, in 2021 due to COVID, or quite recently due to the downturn in markets caused by interest rates rising. Investing in real estate isn't as simple as just buy the flashy building or don't buy the building that's under repair. There are a lot more factors which need to be considered as to whether this will be a good investment opportunity or not. This podcast will cover the purchase of physical properties, investing in mortgage-backed securities, real estate private equity, and real estate investment trusts. So let's begin with the purchase of homes or residential real estate. Now this type of real estate investment is quite common and it can be split into three main types, whether that be home ownership, a rental property, or house flipping. There's two main sources of profit for this type of investment. Firstly, you can generate revenue from renting or leases. Secondly, you can have the appreciation of the asset itself, so the increase in value of a home over a hold period. Let's begin with home ownership. This will be the purchase of a residential property for the owner to live in. You likely know someone who owns a residential property or a home, and this is the most common form of real estate investment, as it comes or benefits from the appreciation of the house value over a period of time. Let's move on to a rental property. This is the purchase of a property with the intent of leasing it out to tenants. The owner becomes the landlord with the income produced coming in as rent. They benefit from the appreciation of the house value as well as the income generated in the form of rent. Finally, you have house flipping. Now this is the purchase of a property with the intention of holding it for a short period of time and quickly selling it. This could be you repairing the building in order to generate value and sell the property at a higher price. Looking into the advantages and disadvantages of each purchase type. Firstly, home ownership has the advantage of capital appreciation, diversification of a portfolio, as well as it can be bought using leverage, such as a mortgage. However, it is low risk and low reward, and it requires a large amount of capital upfront. Moving on to rental properties, this has the added advantage of regular cash flows in addition to capital appreciation. However, like home ownership, it does require a large amount of upfront capital, and tenant quality is key. Damage done to the property by tenants is typically fronted by the landlord themselves. Moving on to house flipping. House flipping only ties up capital for a short amount of time and can offer a quick return. However, it requires a very good market knowledge and is the highest risk out of the three types we've looked at. The market can cool unexpectedly, causing house prices to drop and therefore having to sell at a loss. The value of a property is the estimated fair market value of a real estate property. This is based on market demand and supply, with demand being the amount of interest from a potential investor or buyers in the market, and the market supply referring to the amount of real estate properties available for sale. When we're looking at how to value these properties, there's 4 main appraisal methods. Firstly, you have the income approach or capitalization approach. Secondly, you have a sales comparison approach. You also have a gross rental multiplier. And finally, you have a cost approach, which is the replacement method. Let's begin with the income approach, or direct capitalization approach. This is based off the formula that a cap rate, or yields, is equal to the net operating income provided by a property divided by its property value. By rearranging it, the expected net operating income or property value can be arrived at. Let's look at what net operating income is. Net operating income can be worked out by subtracting direct operating expenses from effective gross income, or the gross income that's generated by a property. Effective gross income can be calculated by potential gross income, take away any vacancy and credit losses. We can also calculate net operating income by starting from potential gross income. Potential gross income refers to the total income that can potentially be generated if a property was listed on the market, assuming 100% occupancy. We take potential gross income and then take away any vacancy and credit losses to get to effective gross income. Next, we take away any direct operating expenses, add on any ancillary income or other income to get to NOI or net operating income. It's a real estate metric that measures the profitability of income generating assets, and it isolates the core operating profits of a real estate asset and neglects any non-operating items such as corporate overhead or non-cash items. This is particularly important if a company owns multiple properties, as it isolates property level profitability from the overall company profitability. So what's actually meant by the capitalization rate, or cap rate for short? The cap rate is equal to net operating income, or commonly referred to as NOI, divided by the property value. The ratio between NOI and a rental property's fair market value is what a cap rate reflects. It's derived from a sales comparison of previous transactions and the property market. Typically, a higher cap rate implies a higher risk investment. Therefore, the market requires a higher rate of return to invest. However, a lower cap rate implies a lower risk and the market requiring a lower rate of return to make an investment. If we look at historical cap rates in 2023, this is a particular year where office sectors were doing quite poorly. This is reflected by a higher cap rate, nearing 11% in some areas. On the flip side, residential real estate was considered quite a low-risk investment. Therefore, a cap rate of 6.1 was the market average. A good cap rate is hard to define in real estate because they're very dependent on the sector, as well as the age-old saying of location, location, location. They generally lie within the range of 4 and 10%. Next, if we move on to the sales comparison approach, this is basing a property value based off previous sales data. You can take figures such as price per square foot or price per meter to determine how much you should pay for an asset. This is similar to comparable companies analysis for stocks and shares, which has been covered in a previous episode. Comparing factors such as the size of property, number of bedrooms, bathrooms, a property's location can all impact how you use a sales comparison approach to value a property. This approach is typically used to work out the cap rate, which you can then apply to net operating income or NOI of a property. Next, if we move on to the gross rental multiplier, this is simply using a multiplier called GRM applied to the annual gross rental income of a property to get its property value. Unlike the capitalization approach, GRM uses a multiplier rather than a yield. It's typically a back-of-the-envelope appraisal method used to get a quick idea as to what you should pay for a property. Finally, we'll take a look at the cost approach, called replacement cost method. This approximates the value of a property by estimating the total cost incurred to replace or rebuild the asset. This includes costs such as land costs, labour, building materials and construction costs, to get a value as to what you should pay for a property. It's generally only used for development projects and market segments where there's very little previous sales data to apply a comparison method to. Let's look at how you can evaluate such investments. Beginning with IRR, this is referred to as the internal rate of return, or the annual percentage yield on a property investment across a predefined period. IRR can be worked out by taking the future value of a property, adding on any cash flows or profit it's generated, dividing it by the present value, and then raising this to the power of 1 over the number of periods. What this reflects is how your initial investment compounds across the hold period and represents this as a percentage figure. The next most common used method is the MOIC, or equity multiple. This is equal to the future value added with any total cash distributions divided by the total equity invested. It reflects the ratio between cash distributions collected from a property and any initial equity you contributed. Looking at mortgage-backed securities next. A mortgage-backed security is a type of instrument that represents an investment in a pool of real estate loans. If we take a step back and look at how the mortgage market looked before mortgage-backed securities, a buyer would apply for a mortgage which included interest. The seller then would receive the payment for the house from the bank, and the buyer would receive the keys in return. The mortgage, which is used to fund the real estate investment, is then kept on the bank's books for the duration. This can be up to 25 or 30 years depending on the type of loan. Every so often, the bank will receive a small amount of the principal, which refers to the total amount of loan taken out, and interest from the buyer. The problem with this is that it ties up the bank's resources and capital. There is an opportunity cost associated with the lack of funds available to the bank. Opportunity cost refers to the potential benefits lost out when choosing an alternative over another. In this case, the bank could have used that money to lend to another person, therefore generating income from that investment. Introducing mortgage-backed securities, or MBS for short. It represents a type of bond which is an investment in a pool of real estate loans. If we look at our previous example, when the bank gave out the mortgage to the seller and receives its principal and interest, the bank will take this loan and similar mortgages with a similar credit rating, bundle these off, and sell them to an investment bank in the form of a bond. Investors can then buy into these mortgage-backed securities and receive principal and interest that's paid to the bank by the seller. What this allows is it frees up the bank's capital. The bank makes money from originating and servicing the mortgage and any other fees, and investors make money from interest and principal, as well as the changes in value of the MBS. Someone can buy maybe 5 shares in a mortgage-backed security, as well as 10, and these can be all bundled together and sold on the market. An example of this would be the iShares MBS ETF, which tracks results of an index composed of investment-grade mortgage-backed securities. Let's move on to real estate private equity. Real estate private equity, as well as asset management firms, raise capital from outside investors called LPs. They then acquire, develop, and operate, and then finally sell these properties to generate a return. This is what firms such as Blackstone, KKR, and Ares do with real estate. Looking at the different risk profiles which REPE firms may invest in, these range from core, core plus, value add, and opportunistic. Core plus is typically a stable income-producing property, whereas opportunistic is a high-risk, high-reward land development. So as we move from core all the way down to opportunistic investments, the potential risk increases, but the potential reward also increases. Let's look at what a potential investment for an REPE firm would look like. Firstly, the firm would conduct due diligence on the property. This would be looking into previous rental records, as well as the market value. They can then find how much they should purchase the property for. They would then acquire the property and then hold it for a typical period of 3 to 5 years. This would produce rental income and maybe up-leasing the property to fair market value. Finally, they would sell these assets at the end of their hold period to generate a profit, as well as the income they generated throughout the hold period. So that summarizes real estate private equity firms. We'll look into public markets now, in the form of REITs, or real estate investment trusts. The purpose of REITs are to make the benefits of income-producing real estate accessible to everyone. Before REITs, in order to get into the real estate sector, you would typically have to have a lot of capital. For instance, the average residential house prices here in the UK was around £300,000, whereas the average commercial real estate cost was about £2,190 per square metre. You can see how such high barriers to entry means that it's very difficult for regular investors to invest in real estate. Therefore, day-to-day people were missing out of the benefits of a real estate investment. Therefore, the concept of REITs were founded. A REIT is a company that owns, operates, or finances income-producing real estate. It's almost like owning a small part of a REIT's assets. Investing in REIT shares gives you access to the real estate market while also the income generated by these assets. This lowers the amount of financing required to get access to real estate assets and allowing anyone to benefit from real estate investments. You can invest as little as £1 in companies such as this through platforms such as Trading 212 or Robinhood. To be classified as a REIT, a company must follow certain rules, such as primarily owning or funding real estate, so 75% of their total portfolio. They must distribute at least 90% of taxable income to shareholders as dividends. Majority of the income for a REIT must be earned from real estate assets, and therefore they must be taxable as a corporation. If a REIT follows these rules, as well as some others, they can be entitled to not paying any corporation tax. There are three main different types of REITs. You have equity REITs, which is the most common, where the REIT owns income-producing real estate. You have mortgage REITs, where the REIT finances real estate owners. Then you have hybrid REITs, which is a combination of equity and mortgage REITs. REITs can also be publicly traded, publicly non-traded, as well as private. Now, the advantage of REITs lies in the liquidity and ease of purchase, as well as the relatively low entry price to investment. However, there are disadvantages of REITs. Firstly, they can be low growth because they're legally required to distribute 90% of their income to shareholders as dividends. Secondly, you as an investor into a REIT aren't only investing in the property itself, you're investing in a company which has selling as well as general corporate expenses baked into this. There are lots of different ways to evaluate REITs, which sometimes differ from general corporate valuations. Ratios such as price to earnings or EV/EBITDA isn't used in REITs as these can be a bit misleading. Therefore, we use metrics such as funds from operations and adjusted funds from operations. To learn more about how you can evaluate REITs, do take a look at the full SEC lecture. So that rounds out our tour on real estate. Feel free to look at the full SEC lecture as we go more in depth into the concept of real estate. It's been a pleasure speaking to you guys. My name's Lassen Wandiarachige, so please feel free to reach out on LinkedIn, and I hope you enjoyed this episode.
Credit to our producers, Aaliyah Friedman, Louis Kim. Head of Marketing, Samhat Raman. Juniors, Ken Zhang, Angie Zhao. Head of Scriptwriting, Alfred Choi. Juniors, Aditya Muthakumar, Kwan Lin. Head Liaison, Lucrezia Poloni. Junior, Ekaterina Vitor. Head of Audio, Isaac Chu. Junior, Cyrus Lee. Head of Sponsorship, Sami Liu and Vladimir Dmitriev. Juniors, Leo Lee, Jamila Tabet, Utkarsh Jetli.